My name's Graham Samuel Gibbon. I'm a corporate tax partner in the tax and incentives practice here. I advise domestic and multinational clients on a range of transactional and advisory tax matters, including tax issues relating to IP exploitation and development, with a particular focus on life science and technology sectors. After this short 20-minute session on tax, my colleague Louisa will be joining to talk about some competition law updates and developments. As with all the sessions, do feel free to put comments or questions in the chat function. I'll try to pick those up, and if fail to do so, then we'll come back to you after this session, or can speak in a networking session later on. So in this session, I'll be covering some tax developments affecting life sciences businesses, both domestic and international, both big and small. First of all, I wanted to just briefly touch on the UK budget from earlier this year. Now, I appreciate many of you will have sat through budget briefings and be well up to speed on the changes, but I think it's just worth covering some of the key announcements. Partly some changes are fairly material, but also as they feed into other upcoming developments in tax law. So as widely publicized, the main headline corporation tax rate for companies was announced to be increased from 19% to 25% for any companies other than those with taxable profits below £250,000 per year. That was the main headline grabber from the budget, but the budget announcements also included a number of changes underlining the desire to make and keep the UK a hub and focus for scientific innovation. And there was some good news for pharmaceutical and life science companies there. For instance, those companies already engaged or able to swiftly engage in expanding their research or manufacturing operations in the UK. There was the announcement of a 130% super deduction for qualifying plant and machinery, and a 50% first-year allowance for special rate assets. This is obviously welcome, but it is only temporary, and that tap is being turned off in April 2023, coinciding with the increased corporate tax rate. So the benefits will be somewhat short-lived. Nonetheless, the super deductions combined with the temporary extension to the loss carryback rules, extended from 1 year to 3 years, which will provide companies with the ability to carry back up to 2 million sterling of group losses for the year ended March 2021 and March 2022 to previous accounting periods, which can potentially generate significant tax savings and cash benefits before the pain of that increase in corporation tax rate starts to take effect from 2023. For larger groups, there were a couple of additional developments linked to the corporation tax increase and Brexit. As of 1st of June, so 3 weeks ago, companies paying interest or royalties to EU-based connected parties now have to rely on the relevant UK double tax treaty to determine the rate of withholding tax to be deducted from payments to EU associates, and the interest and royalties directive that was previously available has fallen away and no longer available. In addition to this, the diverted profits tax will increase to 31% to maintain that delta between it and the corporate tax rate, which is really only of relevance and impact to UK companies that are part of a more complex international group. For smaller life science companies, they may be able to benefit from the additional 375 million sterling, which has been allocated by the government to a new future fund breakthrough, which is a new direct co-investment product that will be used to support the scale up of the most innovative R&D intensive businesses in hopefully a slightly more flexible way than the previous future fund last year, which had a very rigid convertible loan note structure. We're still waiting details. We're expecting those in June. We are still in June, but as yet details are relatively scant. The original Future Fund was far more successful in attracting interest from businesses in the tech sector rather than life science business. I think something like 6% or 16% rather came from the life science sector. But until more details are available, it's hard to tell if the Future Fund 2, or the Future Fund Breakthrough rather, as it's being called, will be a bit more successful for the sector. The government's also investing in life sciences through additional funding for various COVID-related developments, next generation of COVID vaccines and testing, over 700 million allocated to the UK Vaccines Task Force to purchase successful vaccines, 128 million for R&D and vaccines manufacturing, and then smaller sums to increase capacity for vaccine testing and support for related clinical trials and so on. So moving on to more recent developments, most, if not all of you will have seen, of course, the headlines earlier this month around the so-called historic deal reached in London by the G7 finance ministers. Much of the focus has been on the impact of the potential changes in the context of seeking to ensure that tech companies, the tech giants, pay their fair share of tax. However, there could be significant impact on many pharma and life science companies. Although it's worth noting that we're really at the at an early stage of this process, and there have been a number of hurdles and a likely period of a good couple of years, if not more, until any actual agreement is finalised and changes implemented. And it will be interesting to see what comes out of the G20 meeting in July. So what was actually announced? So the published announcement itself covered a wide range of topics, and despite all the column inches devoted to tax, the proposals on tax only took up one paragraph, 150 words or so. And effectively, it confirmed the support of the G7 for the work of the OECD inclusive framework, and confirmed a commitment by the G7 countries to, first of all, reach an equitable solution, so-called, on the allocation of taxing rights for the largest and most profitable multinational enterprises. And secondly, to introduce a global minimum tax of at least 15%, which was the big headline generator following the announcement, effectively providing parent companies with taxing rights and obligations over low-taxed, foreign-controlled entities. So the first change is the OECD Pillar 1, and this second change, the minimum global tax rate, is the OECD Pillar 2. And then thirdly, of perhaps less impact to pharma and life science groups, is the removal of unilateral digital service taxes that have been introduced recently. It is interesting that, unlike the original genesis of the OECD's work, which very much had a clear and stated digital focus, the G7 announcement communique is silent as to the stated target of reallocating the taxing rights. And it's likely this was a concession to the US in order to get them on board and be seen as reaching some form of consensus. So to start with the most obviously applicable change or potential change here, the minimum tax rate. And the reporting of this development has been a bit misleading, implying that a 15% tax rate is the rate that countries will be obliged to apply as their nominal domestic corporate tax rate. And that's not likely to be the case, I don't think. Instead, the agreement would effectively mean that signatory countries who sign up to this, which obviously the G7 are hoping will be most territories, agree to ensure that multinationals headquartered in their jurisdiction have paid this rate of tax across each of their foreign controlled subsidiaries. So the minimum tax would effectively apply at the headquarter level if the parent company is located in an exceeding jurisdiction, by comparing the effective tax rate of profits from each subsidiary jurisdiction to that minimum rate on a country-by-country basis. And where that requirement's not been met, there'll be a top-up at the headquarter jurisdiction to the level of the minimum rate. And the thinking behind this is to remove any advantage that groups have enjoyed by establishing subsidiaries in low tax jurisdictions. The incentive for a group to do that is sort of cancelled out by corresponding obligation to top up tax at the level of the ultimate parent company. So to avoid the so-called race to the bottom on tax rates. Where the parent company is not in a jurisdiction that signs up to this, other mechanisms will be needed, and I think the detail on how that will work will need considerable further development. I mentioned the reference to a country-by-country basis. This, I think, suggests that it will not be possible for groups to take a presence in high tax jurisdictions into account in calculating a sort of a blended effective tax rate, which is a feature you see in some tax rules in different jurisdictions, like GILTI rules in the US. But it will be on that country-by-country basis. I think a large part of the negotiations will depend on and focus on how to calculate that effective tax rate, because obviously any tax has two elements: a tax base on which the tax is levied and a tax rate. And it looks like agreement on that, on the number, the rate is gaining momentum, but that agreement will be complicated by different jurisdictions having a different view as to what constitutes taxable income, allowable deductions, and so on. You know, the UK has a broader tax base than many other jurisdictions, in the case of many taxes. But to have a consistently applied global minimum tax, there would need to be some form of standardized, agreed upon measure and parameters. What are the tax base? What are the scope of profits to which the rate applies, and what are the permitted tax adjustments and deductions and so on? And it's on these questions, I think, that pharma and life science companies will be most concerned. One particular question will be the impact on the UK patent box and similar regimes in other jurisdictions. The UK has a well-established patent box applying a 10% rate of corporation tax to profits earned from patent inventions, and the regime, whilst a little cumbersome and complex to operate, especially in some manufacturing industries, operates pretty well and is generally well regarded for profit-making pharma and life science businesses that undertake a significant proportion of their R&D from the UK. In the context of the recently announced increase in corporation tax rate I mentioned earlier to 25%, it looked like the patent box would be of renewed and increased importance and value, as the delta was increasing from 9% as it is currently to 15%. But there is that question that remains unanswered of how will patent boxes, and the UK is not alone in having a regime along these lines, operate in a minimum effective tax rate world. Generally patent box regimes and similar are viewed as an incentive to investment and innovation, but then there are those who consider it a means of tax rate shopping and erosion of tax base, albeit that latter point was really addressed a few years ago with the harmonized changes to patent box and innovation box regimes that tied the benefits to jurisdictions where substantive R&D is actually undertaken. So I think the way things are moving, if this 15% country by country basis proceeds, the patent box will remain of value in the UK in narrowing, the delta from the headline corporate tax rate down to the 15% minimum rate, but it will be less valuable than it is currently, where a 10% rate applies. So there will be that slight erosion of the benefit unless regimes such as patent boxes are factored into the minimum tax rate global tax base. Another question is the impact of R&D tax credits and other incentives, such as enhanced capital allowance deductions and so on. So again, this all feeds into the question of the tax base and how this is measured, and will there be factoring in of these sort of incentives that are designed to promote R&D and to promote innovation and so on. So it's really going to be important for the industry to see how these ignoring the sort of headline minimum rate, but how that is going to work in practice in the context of these sort of expenditure and so on. The other principal change I mentioned is this from the G7 announcement, is this reaching an equitable, so-called equitable solution on the allocation of taxing rights to market jurisdictions. And this refers to a new introduction of a new nexus rule to provide relevant countries, such as to provide relevant countries those in whose markets non-resident companies participate through engaging with consumers and users, the right to at least 20% of profits exceeding a 10% profit margin. Now, it is stated that only the largest and most profitable multinational enterprises will be caught. Interestingly, the approach is simplified from the original Pillar 1 proposals, which sought explicitly to identify automated digital services and consumer-facing businesses. As originally formulated, it was questionable how relevant the developments would be to groups in the pharmaceutical and life science sector, and it may be that they are not ultimately particularly relevant, but that sector focus and targeting appearing to have been dropped, again, largely at the US's behest, could capture life sciences in principle, unless, subject to understanding the rules as they develop, and unless the sector is explicitly excluded on policy grounds or so on. I mean, obviously, the business model of a life science company will often rely on a long cycle of investment followed by a relatively high margin commercialization period for successful products. So, one of those threshold features referred to in the announcement, that of high margin and profitability in commercialization, may, ticks that box. In a conventional IP and supply chain of a life science company, you wouldn't necessarily expect that companies would be the targets of this sort of proposal, and certainly typically the unilateral measures adopted by countries in imposing digital services tax have generally not impacted life science companies directly. But one area I suppose to keep an eye on is where life science industry does have a considerable involvement in digital, I suppose, in digital initiatives, for example, in collecting and processing patient data to understand outcomes, and that's an area where we could see impact creeping in. So this pillar will not end up hopefully having a material impact on the life science sector as much as perhaps the global minimum tax rate, but I think it's an important one to keep a watching brief on. I'm conscious I'm running short of time, so apologies for that. I think just to flag, coming back to the domestic UK front, having yammered on about international developments for a while, we had the budget, but there's now on the horizon other changes that I think we're going to see, specifically coming out on the back of consultations and calls for evidence. The one particular area that's relevant to life science companies, particularly at the early stage of their life cycle, is that of EMI incentives, which are obviously hugely enticing and attractive way of getting and holding employees. There's been a call for evidence, and the hope is that we will see those rules relaxed a little, because they are quite, a lot of them haven't changed in many years and they're quite constrained. I think we'll see changes from that perspective. Also, an R&D tax credit consultation again, that has been mooted as you know, a promising thing, and we, with a view to expanding and incentivizing R&D, but you have to have in the back of your mind that the revenue is very nervous about R&D tax credit avoidance, advisors who charge fees based on a proportion of R&D tax credit benefits. That's considered you know, ripe for avoidance and negative behaviours. And I've got to the end of a tax talk without even talking about CGT, which shows poor time management. So apologies for that. There is obviously, everyone is mindful that at some point the CGT rules may change. The revenue didn't take the opportunity in the April budget to make those changes. I think it will. There is some nervousness in the market. We're already starting to see transactions gearing up to be done before autumn, before any form of autumn statement. Although I think, you can't hold me to this, I think any change is likely to is more likely to be implemented from the budget next year, but that remains to be seen.